All right, welcome to a very special edition of the On the Tape podcast. And it is special because it's a special drop. It's going to drop on Thursday.
Do I look? I'm trying to assume a certain posture in this chair.
Yeah. You don't love it? I love this chair.
It's like success.
Yeah.
Like I'm relaxed. I'm good. Am I in that?
That's the vibe we're trying to give. We breed success over here.
This is too much.
Yeah.
And then this is like...
Well, you've podcasted a few times before. You have to lean into the mic, okay? And, we have cameras coming at you and this and that or whatever.
I want to come across
So this guy who's speaking right now, who's just taking over the podcast before we've even gotten started, this is Josh Brown. He's the CEO of Ritholtz Wealth Management. He is the star panelist of CNBC's Halftime Report. And he's also the author of his third book, You Weren't Supposed to See That, by Joshua M. Brown. What's the M stand for?
Morgan.
Okay, welcome to the pod. Hey, by the way, this is what we do with most of our folks, or probably all of our folks who come on who just wrote a book. We're going to give away 100 of these free books. All you got to do is go to the Apple Podcast Store, leave a review, screenshot it. You know what to do. You're going to send it to Amanda, her address, contact@riskreversal.com, and you're going to get the first 100 a free book. How cool is that?
That's super cool.
All right, I read this book. I'm actually, and I said to you, quite honestly, I'm about 2/3 through it. I love it. I did do... I was going back and forth between the book and listening to it on Audible, and I listened to it at 1.7 speed. I feel like for the last 2 days, you've been yelling at me. Like, I'm like, oh, you are so in my head, by the way. I'm going to tell you that right now. But it is easy to go back and forth because the way that you have constructed the book, you have these kind of short bits, and then you comment on it, and then it goes to the next thing. So I really love the book. And, you've written 2 books before.
3
books.
3 books.
What? Wait, so Backstage Wall Street.
So Backstage Wall Street is 2012, and that's the only book I wrote by myself.
Okay, and then you wrote one with Jeff Mackey.
So the Jeff Mackey book was the follow-up. It was kind of like Backstage Financial Media, but we called it Clash of the Financial Pundits.
Oh, right. I love that book, actually.
So for somebody like you, that's a home run book because most of the people we're interviewing, you know them, and... We got like Jim Cramer, and we got like some famous...
Henry Blodgett. I love that one.
We got Blodgett.
Yeah.
We got some like famous market commentators to talk about what it's like to be a market commentator.
Right.
And then I went back through history, and I was doing like old school, like Granville, people that aren't alive anymore.
Yeah.
The third book was 2020 during the pandemic. We did How I Invest My Money.
Oh, yeah.
We went to like 20 financial advisors and said, don't tell me what you do for clients. What do you do for yourself?
Yeah.
And then we let them author the chapters, and then Portnoy and I edited it.
Okay. So by the way, you and I were just talking before we started recording. I love the evolution of these books, and it really is an evolution. And every time I talk to you after one of your book parties, you're always like, "I'm done. I'm not doing that anymore." And then I look up.
Trust me.
I look up, and then there's a new book. Now, one thing that you did do is you shut down the blog, and I think that's where people really started to get to know you. That was a few years ago. You'd already been off Twitter for a couple years when you did that.
Yeah.
So interesting stuff. I just wanted to say one thing. So we're going to get by the book at some point. We're going to talk about just the current market environment. I really want to get your take on Gen AI, not just the secular shift in technology and how you're thinking about it, but really what it means for the markets. And really, I think the most important point right now is we had that really sharp sell-off in a lot of the names, but it's a really narrow group of names that have been benefiting from it. And really, if you think about the pull forward in market cap and what their contribution of sales and earnings right now, it's not great, right? So this is the thing that we have to think about as it relates to the broad market, if that makes some sense to you. But first things first, I have a bone to pick with you. Okay, so you went on a podcast before ours. I think it was the Odd Lots podcast, and the title of that podcast was Josh Brown on how he created a financial media empire.
Do you think I titled
a
Bloomberg podcast?
I freaking love it.
You think I said to Joe and Tracy, here's the title of our episode?
Now, here's the deal. I didn't listen to the podcast yet because I don't like to listen to pods before I'm going to do a pod. I will listen to it after and see whose was better, but we'll see about that. All right, let's talk about this. What I loved about this book is that it feels really current. because for two reasons. You've gone back since you started blogging. What year was that? 2009 or something like that?
Yeah.
At the bottom of the market in the financial crisis. And you've picked out, I want to say 20, how many like blogs that you've written over that period of time, the last 15 years?
It's like 20. We smashed two of them together, Scarcity and Abundance.
Yeah.
So maybe it's 18, maybe it's 19. But
and then you drop in with your 2023, 2024 voice, reflecting on it. And I love that. And so was there a common theme about the blog that you chose, the blog post that you chose over the last 15 years?
So I'm really glad you asked that question. I didn't think that there was until I finished the book, and someone who read the manuscript said, the through line in this book is like what you're really doing here. You're talking about every topic under the sun related to investing, but you're connecting the humanity of the players involved and their motivations and their incentives and their emotions and the things that drive the people. That's what you're doing in every chapter. So when you do this chapter about a actively managed mutual fund wholesaler who loses his job, and you write it in the third person, you write it in his voice, you make him the narrator, and you tell the story of active versus passive from the perspective of one of the victims of that trend, you're not just writing a textbook chapter about active versus passive. You're telling the story of the people who are involved in that. And once it was pointed out to me, I went back and looked at each of these stories that I told, each of these chapters. I said, you know what? It's not about finance. This is about people who are affected by various things happening in finance. So if you ask me, like, what is the book really getting? What is it? It's not about me. It's a little bit about me, but it's really about everyone involved in all of this stuff is just a person. And when you have that insight, you start to look at investing and trading and markets and economics. You start to look at things much differently than they appear on the surface.
Well, it's about human nature too. I mean, that's the 100%. Through line, and you and I've talked about that before. I mean, you're not blogging just to break something down for the here and now. This is back in the day before you gave it up. You're really trying to condition the listener, the viewer, the reader into thinking about how you make decisions about this stuff, and you know what I mean. So I think that's really interesting. I want to go back to one thing. It's like you and I met. You and I have a very unlikely friendship, and I have a ton of respect for you. Well, no, I do, because if you read these books, but you are unapologetic about where you started. Yeah. Is that fair? You often refer to some of the guys, I guess like me, who are lax bros in college.
You're not in there.
There's a lax bro reference.
So you're the only person that played lacrosse and worked on Wall Street?
Well, you basically said because of the algos and because of the machines, there's a great blog and a commentary. So for all you lax bros and frat boys who got to Wall Street, it's over. It's done. You better
said that?
Yeah, it's in there, man.
In those words, are you paraphrasing?
You said lax bros and frat boys.
Are you both?
So if you're
are you not both of those things?
If you're listening to this right now and you want 2 books, okay, 2 books, find that quote, send it to contact@riskreversal.com, and you'll get 2 books.
Okay.
All right. But what I'm saying is I started that way, okay, to be very clear.
Good for you. I'm jealous.
No, I know, but
you didn't make it to the end of the book. Had you made it to the end of the book, you would realize that I wish I played lacrosse at Princeton or whatever. Believe me.
I know, but when you think about, and I talk about this all the time, is that, a lot of my friends who came from Ivy League schools and started out at fancy places, and by the way, where I started out in the business was not fancy at the time, and we can get into that for a second. Most of those people are out of the business.
Is that true?
Yeah, a lot of them. I don't know what the hell they're doing. They're at other places, or they're doing very different jobs than they started out doing. Now, there's plenty of them who've done fantastically well. But I had friends in the late 90s, as you probably did, who were in law school, who were, in some other profession. And they were like, and you talk a lot about FOMO in the book, but, who they had to be in the stock market. You know what I mean? They had to be in crypto, 10 years later, or 20 years later, whatever the hell it is, whatever, they had to be flipping homes, you know what I mean? Back in, they had to be trading gold, whatever. So
I know those people.
Yeah, of course. You know them all. But I think your evolution is pretty fascinating and you and I met because of CNBC, and here we are all these years later. How many people have you seen come in and out of CNBC's universe?
A million, but the unlikely part threw me because I liked you the first time I met you, and I always thought of you and the role that you play on TV as essential. I don't want to say that you're so it would be a caricature to turn you into like, the token naysayer.
Yeah.
I think that you're the person that brings people down to earth. Sometimes you're right, sometimes you're wrong, just like me and everyone else, but that's an important role to play. The thing is, most of the people who play it are unlikable. Yeah. They're dicks.
Yeah.
They're rooting for other people's downfall. That's the opposite of you. You lift people up, but you also bring that cynicism, that skepticism that is sometimes missing. I think that's really essential. I think it's why your role on Fast Money at 5 is like nobody could do what you do. So I don't know if anybody tells you that.
No, I appreciate
You're
that.
An affable skeptic. You're not a doom and gloom guy,
Yeah.
and you're not a perma bear, and you're not like the token, oh, this guy's going to come on and be bearish. But you bring that with like an affability, and it's really a rare combination.
Well, there's two things
do
there,
it well.
and you and I have talked about this before on your pod. Oh, I forgot to give a shout out to Compound and Friends. You guys have you guys have an amazing podcast network too. You have something for everyone, which I really love. And you guys have done something on Compound and Friends, and it feels like this right now, where you've made it very accessible, right? So like, and you bring in a lot of similar guest sort of things.
Yeah.
We're a little bit more all business. We do a lot of movie references and music references, and that's as good as it gets. Guy, as you know, is one of the most affable guys in financial media, and Danny's been a great addition to us. He was actually with us from the get-go. But what I want to say about that is is there anyone in your network who plays that role? So for me, when I got to start doing Fast Money in 2011, but you ready for this? I started doing Options Action on CNBC April 9th, 2009, a month after the market bottom. And no one knew.
Timing.
Yeah, no one knew. I have people email me, Josh, and say, well, you've been short since April 2009. Right. Now, people who just drop in day to day, they're going to take away what they want to take away. What I felt like when I started in the business, if you're going to be bullish on something, you have to know what the bear case is. And so that's what I've tried to do over the years. And if it labels me whatever, so talk to me a little bit about that.
I think you do it well. And somebody has to do it. And most people would not be able to do it, but then still maintain the part of their persona that's inviting and welcoming to people. So I've always appreciated that about you. What we try to do with the Compound Network is, I don't know that we're popular with day traders, people that are doing like 0 day to expiration options.
And your Twitter was.
Yeah. So I think we do good market commentary, but I think the core audience are people that, whether they're professionals or they're individual investors, people that just want a take on the news of the day that's not insane. So we will frequently laugh at wildly bullish things with the same aplomb that we'll laugh at wildly bearish things. And I think that down the middle approach is our lane.
Yeah.
And we're never really looking to expand on that and get to someone that doesn't currently like us. They find us. Yeah. So we're not trying to convert people, but I think within that lane, it's most of the American population, quite frankly.
Yeah, but thinking about what you guys do, you run a wealth management company with billions of dollars under management. These are generally high net worth people. You and I have talked about a little bit of sort of the customers that you are willing to take, and they have to buy into what you guys do. So you generally have to be optimistic. There's lots of examples in the book where you're basically saying you have to get more aggressive on the downturns, right? Especially if you're thinking about, the long term or whatever. One thing I'm just going to say really quickly is that I don't think you and I are ever going to get Botox. Guy always says he's got to dance with the girl he brought to the prom. I have, from that skepticism that you just mentioned, it's largely just from doing 3-4 times a week CNBC's Fast Money. I have this crease right here, and that's just like me squinting at somebody.
Kidding me?
I have this. I have it right there. So it's going to be there forever, people. It might get worse. You know what I mean? But it's there. So talk to me a little bit about that. You're essentially, if you had a perma bear who worked for Ritholtz, it would not be a good fit. You know what I mean? At all. He wouldn't, they wouldn't have a blog. They wouldn't have a spot in your podcast.
We're talking on Wednesday, September 25th.
Yeah, we are.
Last Thursday, the S&P 500 made an all-time record high. Every single decision to get out of the market over the last 100 years has been a bad decision. Every single decision to buy has been a good decision. And every single decision to buy when the market looked really bad has been a great decision. So that's the story of what it's like to be a long-term investor. There are no long-term bears.
Yeah.
Okay.
Well, you're dead. You're
now.
Gone.
Is it always the best possible time to buy stocks?
Yeah.
Only in the glowing light of extreme hindsight. But our argument has always been, look, for most people, you're not in retirement. You have to buy.
Yeah.
So what's the difference? It's basically a one decision lifestyle until you're 65. So we're talking to people in their 20s and 30s. That's like what are we talking about here? A tactical opportunity to miss 10% downside?
Yeah.
A, let's say you do. Then what? How do you know when to get back in? And B, what if you just don't bother?
Yeah.
What if you take that time and effort and focus it on your career? I guarantee you, in the latter case, you're making more money. So I think we try to give people that perspective. And yeah, sometimes it feels stupid. So I mean,
you wrote you
got to choose.
Yeah, you wrote by the way, I sorry if I got distracted. Melissa Lee just texted me asking about the place I went to last night.
Shout to Mel.
I was like, how was it? I said it was great, 8.5. Let's go.
Where did you go?
I go Cha-Cha Tang. It was very good. It just opened recently, and I told her she's obviously of Chinese descent, and she loves Chinese food. She just calls it food. But
we just did the Jean-Georges Chinese place in the Tin Building. Wow, what's that called?
Oh,
the Red Pearl.
Oh, really?
Off the chain.
I love Chinese food,
and I'm
so
going.
I'm gonna check that out.
Do you want to come with? You want to come with me in 2 weeks? We're going to Nomad Tea Parlor.
Oh yeah.
Have you been there yet?
No. No Moi. Yeah. No, I've been there a lot. So one of the co-owners of Cha-Cha Tang is from Noma. His family was involved in that for years. So
Okay.
I love that place. It's a dim sum place. And we're not going to dox each other because if anyone wants to whack us,
yeah.
you know what I mean?
Well, I didn't say the date.
Yeah. So back to the market. So you wrote a blog post, I want to say 10 years ago, probably around the time that you started the firm, and you kind of laid out in a succinct way. I mean, you could post that thing right now and it would be, perfect. Nothing's really changed, but you talked about the confluence of the investment community, and you talked about how the wirehouse capital, right, was going to a fee-based sort of thing, which kind of changed the game. There were some other dynamics right in there, ETF creation and all this sort of stuff. Talk to me a little bit about that, why it was so important then when you were founding the firm. It might have sounded a little self-serving back then, if that's fair. You guys probably started with a few $100 million. Is that correct? And
No.
Oh,
60 million.
no way.
Yeah.
No way.
Yeah.
So what do you have now, if you can?
Like over 5.
Wow. That's amazing.
So our last form ADV was 5. It's higher now, but I can't say anything until we file again.
No worries. So talk to me why.
That's the most important piece I ever wrote.
Yeah.
So it was called The Relentless Bid. Is that what you're talking about? The Relentless? So that was an insight that I had that I think I was probably the only person that could have had it because of my very unique career circumstances. And I recognized this trend in wealth management and financial advice, which is like $30 trillion.
Yeah.
I recognized this trend where every firm, I mean, this was a novel insight 10 years ago. Now everyone understands this. But back then I said, all this transactional business is going away. Advisors are opting for financial planning first, followed by portfolio building vis-a-vis ETFs, indexing, et cetera. That's going to reduce the amount of panic selling, and it's going to raise the amount of rebalances into stocks when they come down. And that's going to have an effect on how the stock market itself behaves during corrections. The question was, why are the corrections so shallow, and why are they so short? And why can't fear in the market last more than 3 days?
Yeah.
And the answer was the dampening effect of 20,000 advisors coming in with their clients hundreds of billions of dollars and buying these dips as fast as possible. And why are they doing that? Not because they have a market view, but because the math of the financial plans gets better when you add more stock exposure at lower valuations. We're all using the same 5 pieces of software. Now, a lot of people at that time, it had not occurred to them that the incentives and the business model shift on Wall Street could have that kind of an impact on the way stocks themselves are behaving day to day. So when I wrote it, the reaction was ridiculous. Like
pushback.
No.
Oh.
Very, very senior people
Somebody finally
at
said
Morgan
it.
Stanley,
You know where
at
that's
Goldman
from?
Sachs. Like,
Yeah.
I never connected these two things. But yes, we are shifting our entire business model to fee-based, less active management, less transaction, less churn. And therefore, as a result, if everyone is doing the same thing we're doing, of course it's going to have an impact on how stocks act. So that was the piece that I really said to myself, I'm like I should be taken
What was
seriously.
it? What was it called?
Because I was like a clown a little bit.
No, I mean,
No, I never took myself seriously.
I was being sarcastic.
But I said, like, all right, this was really unique, this insight. And revisiting it, the crazy thing in the new book, going back and saying, was that, like, did that have a lasting effect? I actually underestimated the power of that. And then the piece that I should have spent more time on but didn't was the 401k piece. The 401k piece is the bear killer because this is equivalent to the flows coming into Berkshire Hathaway. The flows coming into Berkshire Hathaway are not mutual fund flows. It's market performance insensitive money. It's people making their car insurance payment. People don't understand that. The secret of Buffett is not what a great investor he is. It's that he set up a system where the money coming in was not dependent on how he did last quarter. That's what sets him apart from every mutual fund manager. If they don't perform or if their asset class is out of favor, they're getting redeemed. Buffett doesn't have that issue because nobody stops paying car insurance and they don't care how Berkshire's portfolio is done because they're not sharing in it. Okay. 401k is the same thing. We know from 2022, the worst bear market for asset allocation in history. You have to go back to the 1700s to find a combination like that. Stocks down 20%, bonds down 18%. Never happened before. Okay, you know what Vanguard 401k investors did in response to that? Fucking nothing. Nothing. We have the data now. Nobody changed a damn thing about the allocations coming in. They were as automatic as Geico payments coming into Berkshire Hathaway. The effect of having 401ks in the trillions and that kind of monotonous, just money into stocks, that has had an anthropomorphic effect on the stock market.
Just explain what that word is.
To the point where the stock market itself acts like a calmer investor.
Yeah.
Now, we had a VIX spike to 63 the other day. I understand. And I'm not suggesting.
No, it's totally goofy.
Not saying it's like a permanent get out of jail free card.
Yeah.
But if you don't understand that very basic thing, that the character of the buyers of stocks itself has changed, then you don't understand the modern markets. Yeah. So I get into that stuff in the book, and I think it's really important.
So I just made a Jerry Maguire reference. I'm sure it's one of your favorite movies, 1996.
Who doesn't like Jerry Maguire?
So when I said somebody finally said it, when Jay Moore it says that because people
Sugar?
Sugar, because he wrote a mission statement, not a memo. It was the things we think but do not say.
Yeah,
you know what I mean. And again, I was thinking about that a lot. I was reading this book, but it was kind of the end of Jerry effing Maguire. If for all intents and purposes. Really quickly, I just want to say this. So you said $30 trillion of investable assets. That just here in the U.S.
I think wealth management is $38 trillion.
That's crazy because our GDP is less than that. If you think about that. So pretty fascinating stuff. One thing I wanted to say, so going back to, and again, you started in the markets, in the early 2000s, mid 2000s?
Late 90s.
Okay, late 90s. So folks like us, and maybe not you, I have a little PTSD from the bear market that started in March of 2000.
Everyone does.
And we didn't bottom until 2002. Yeah. And as you were, I was a young market participant at the time. And then, animal spirits get going again. And then we have house flipping and commodity trading and levered up to do whatever the hell you wanted because they just stayed easy for too long. And then the banks just, they went haywire, no risk management, all that stuff. And then they almost bring down the financial world as we know it. Now, that bear market, November of 2007 to the lows in March of 2009, that felt really bad too, and very differently because we had major financial institutions go down versus a bunch of no earning internet stocks in the prior bear market. So two protracted bear markets, they both had very big recessions or protracted recessions in them. Fast forward to 2020, okay? No one saw, we talk about black swans all the time. 2000, not a black swan. Everybody could see it. You couldn't put your finger on when it was going to happen. Same thing with the financial crisis for all intents and purposes. But you talk about it in the book. It was the quickest down 30% or 35% we've ever seen, and the quickest rebound from that
Quickest
thing.
double ever.
It's insane, right?
You're talking about March and April of 2020.
And I got to be honest. I mean, we all knew it was going to bottom in the speed in which it did, but I thought it would be down 50%, to be very clear. Okay. And you use this example all the time. Put some crazy below the market bids in, that sort of thing. You know, that works.
I got to tell you one thing, though, Dan, and I told you this on a prior episode we did of the show. It was the only crash that I've ever experienced where the clients were calling us to buy.
Yeah.
I have never,
because they just thought it was so irrational. Or
I very rarely get surprised by people's behavior in the market.
Yeah.
I've been around as long as you have, and I just, it's like, for me, I look at this like, here we go. This floored me. I'm not taking these calls. The advisors, I had maybe 10 or 11 advisors working for me at the time. They were calling me and saying, you wouldn't believe it. I got people sending me money, wiring money from the bank, or liquidating things to put money into stocks. At first I was like, all right, that's like one anecdote. We literally had like dozens of clients saying, how can I get more money into the market? And then when the checks started going out, it was even more so.
And then anything that wasn't bolted down, whether it was a
I was
house,
shocked.
a Rolex, or this and that, whatever.
I would not have predicted that.
I've heard that from other advisors too, and so I do think that's pretty interesting. But then that led to the fixed asset bubble that we had in back half of 2020 into 2021.
Yep.
The thing that I want to go back to one other thing. So in 2022, okay, so if you know me as a skeptic, you know I was doing Fast Money, I was doing like Sarah's show, Closing Bell, that sort of thing, and you know. They would bring me on because they think I would have a very skeptical view
Closing
of what's
Bell overtime. Which is it 3? Which is it 4?
It was whatever Sarah was doing with Wilf, and I love Wilf. You know, but I had this thing, and I said it again and again and again. Qs and 2s, right? So rates came down so quickly, and so many people were convinced that it wasn't going to be the prior leadership that leads us out. And I think you and I were in the same camp. It had to be the prior leadership, because if you add up all those other sectors, you know what I mean? And this is before these all became $1 trillion market caps, or $2 trillion or $3 trillion, right? So that was kind of my views. Just buy 2s, because ultimately the Fed is actually going to have to lower rates, you know what I mean? From the thing, rates went up so much quicker and by so much more than we ever thought. And then Qs, they were going to lead us out. If that strategy would have worked really well, you know what I mean, if that's what you're doing. So talk to me a little bit about where you think we are right now. You just said, I guess we've had 41 new highs in the S&P this year.
Yeah.
So how do you advise clients right now who they're set it and forget it? They get more aggressive when the market goes down. So maybe early August, they got a bit more aggressive. Maybe early September they did.
So, all right. So this is really important. The S&P is up 19% year to date as we're speaking today. If you pull out the top 5 stocks, it's up 11%.
Yeah.
So about half the performance has come from 5 names.
Yep.
You don't have to like it. You just have to accept it. It's been that way for a long time. What's changed this summer is that now that we have rates coming down, you're getting a lot more participation from a lot of laggard sectors. Mm-hmm. There are... I think 160 stocks in the S&P 500 that are up more than 20%. Mm-hmm. Some of those are up 60% on the year. None of them are tech.
Yeah.
So, okay, this is really important. Number 2, yesterday the S&P 500 had 63 new all-time highs. You know how many all-time lows? 0.
Yeah.
Okay, that's the market we're in. Again, if you spent the first half saying this is artificial, this is NVIDIA, but whatever you're crying about, now you have to recognize that is not what's happening. What's happening right now is extremely broad-based. It's international. It's growth and value. Mm-hmm. It's utilities and pharmaceuticals as much as it is GPUs. And that's an amazing environment to be in. I love when the tape is this way. Now, can it keep going forever? No. So what am I watching? When I see 80% of the S&P 500 above its 50-day, mm-hmm. That's it.
Yeah.
That's when you say, too hot. Stove is too hot. This is going to blow off. We're not there yet.
Yeah.
We have, I think, a median RSI of 64 among the best
relative strength index for some of those
among
folks,
the best stocks. Yeah. And then the rest of the stocks are all in the 40s and 50s, which mean they can get stronger. So, you know, it's not forever, but this is an amazing time to be an investor because there are several growth drivers depending on the sector, depending on the type of stocks you own. You're winning for a variety of reasons. It's not just AI, and it's not just low rates. You've got another housing cycle coming. We see mortgage applications now ticking up. KB Homes just reported a negative earnings report, but then they said since the quarter closed, with rates coming down, we're seeing activity. So I love when there are multiple ways to win. I don't love narrow markets, but I also don't get the choice. So you had to suffer through the first half where NVIDIA is up 140% and the median stock is negative. You have to live through that if you're a portfolio manager.
So a couple things right here. So again, stocks at all-time highs, rates come down. There's some activity in the housing market. You know, KB Home, they might be right, they might not be right. When you look back at what the Fed Chair Powell just said, why did they lower interest rates, Fed funds by 50 basis points? They're trying to support. Now they think, he said this, that their dual mandate, right, stable prices and full employment have come into balance. Like at least the risks, the way they see them, they feel very confident they're going to get back to their 2% target. So they see something in employment that kind of makes them a little nervous. I think that's kind of clear to say. I don't know if you caught, this was on Tuesday, that consumer confidence number, it was down like 8.5 points. It's the lowest.
Throw that out. It's not useful.
Well, it is and it isn't. I'll tell you why. Because it's a sentiment number.
It's political.
Well, it might be, it might not be. But all I'm saying is that with the stock market at all-time highs, rarely do you see that sort of bifurcation with consumer confidence, especially if you have this wealth effect, right? And again, we don't have to
Dan,
debate
when
it.
Trump is doing well in the polls, consumer confidence rises. When Trump has a bad week, like a bad debate or something, consumer confidence falls. It has literally nothing to do with the economy.
Which is really dumb, though, by the way. If you
because
think back,
it's the mood of the respondents.
Yeah.
We know that compliance for these surveys is at not recent lows, all-time lows. The JOLTS report, that's 8% of respondents, meaning 92% of the people who receive that survey don't respond to it. It's junk data. Throw it out.
Totally fine.
I'm making your life easier.
I'm not trying to create a mosaic of bearishness with the
I get
markets
it.
at all-time highs.
I'm saying these are the things that have not helped anyone.
Right.
We can cling to them because people in the 90s did, or we could say, you know what? I'm going to simplify my life. I'm going to throw away all the things that don't bring me joy or make me money. Consumer confidence is one of the easiest things to throw out.
So let me ask you this question. So I know your voice on your podcast and when you're writing and how you speak to your clients. How do you go back and forth between a live show from the New York Stock Exchange, okay, at noon in the middle of the trading day, where most of CNBC programming is for institutional people who have it on, okay? It's for that prosumer, like that self-directed sort of folks. And then it's those people who are just, it's their kink. It's like the markets are their hobby. You know, they might not watch SportsCenter or what's going on all weekend, you know what I mean, in the NFL or college football, but they love watching CNBC. So you're a personality on that. You work with an ensemble cast. There's the back and forth. There's certain entertainment values. But at the end of the day, Scott Wapner, you don't mess around. You know what I mean? Like, if you're full of shit, he's going to call you out. And again, he's a great friend of both of ours. So you have to speak to the audience that's there. You can't speak to, you know, your clients, you know what I mean, through your own advisors, because that's their responsibility to do that, right? Yeah. So talk to me a little bit about that.
So I'm talking to the person that's on the treadmill, and CNBC is what they would rather watch than CNN. Or they've already seen ESPN. So they already watched the sports highlights from last night at 7 a.m. or at 8 a.m. Now it's 9 a.m. in California, and they're on the treadmill, and they're watching CNBC. That's who I talk to. And that's people with $10 million who set their own schedule. And it's also young people who are just trying to learn the market for the first time. And then it's also just regular, you know, middle-class people that they're interested in stocks. And it's really hard to say something that's relevant to everyone all at once. So the best way I can answer your question is, I'm doing the show with Scott like 12 years. I think I'm one of the only original halftime report people left. I know what Scott is trying to draw out of me. Usually when he goes to me first. And I think I'm there to set the stage. These are the important things that are happening that are worth mentioning. I think I do a really good job at that. And there are other people on the panel that are there to say different types of things. But I'm giving a very general overview. If you're watching the market now These are the things that I think are the most either interesting or crucial to understand about what's happening. Once I deliver that, from my perspective, the rest of the show is much easier, because the rest of the show is, here's a specific question about a specific stock. It's the generalizing and trying to capture everything that matters in 30 seconds to a minute. That's this, from my perspective, that's the skill. That's really the key thing that I'm trying to do there.
Yeah, so it's interesting. I can't remember if it was in a blog post from years ago or some commentary from the last couple of years, but you said at one point the active trader community is probably 3 million, and you were taking the under on that.
Yeah, it's small.
Okay, so then if you think about it, at any given time on CNBC, they probably have at best 500,000 viewers. Now, a lot of people are consuming that content online, and that sort of thing. So let's be really fair about that. If someone comes to you and say, "Why are you still doing this, that, or whatever?" It's like you see the numbers; they're going down.
They don't understand.
They're actually net up. You know what I mean? The way people are consuming.
Saturday Night Live has more people, and when I say more, wait till I tell you the numbers. Saturday Night Live has estimated that it's 1,000% higher viewership consuming the show in 3-minute skit clips on YouTube than are watching it on NBC Live at 11:30.
Right.
This is just the reality of the world that we live in. Again, you don't have to like it, but the truth is, a 3-minute, highly produced clip from CNBC on CNBC.com or on YouTube is a better 3 minutes spent for most people than a lot of the independent shit that people are putting out on Spaces.
Right.
It's just a fact.
Does it surprise you, though, given that mindset, that people are willing to listen to you or me and Guy and Danny, and obviously Batnick? We got to give a shout out to Batnick. We haven't said Batnick's name yet.
Shout out to Batnick. Can I tell you one thing?
Yeah.
So I listened to Seth Meyers on a podcast this week. He was talking to Matt Bellany on The Town. Mm-hmm. And Matt asked him, so Seth Meyers lost his band last year. So he's got the show at 12:30, the late night show on NBC.
They're cutting costs, lose the band. Is that what's going on?
He lost the band.
Oh, wow.
Okay. But he also, at the same time, has a couple of recurring bits that become supernovas every time they're posted to YouTube. Mm-hmm. And his advertising team just hasn't figured out how to monetize that yet, but it doesn't mean no one's watching. The audience has decided they're going to consume Seth Meyers in a different way than maybe they would have in 1996. Mm-hmm. We could get mad about it, or we could say, this is the way the world works. And to Seth Meyers' credit, he was kind of talking about look, I can't force people to consume what we do in any specific way, even though it might be more profitable.
Who the hell's up at 12:30 watching Seth Meyers?
So this is the world that we live in. But what Seth Meyers said, so Bellany asked him, do you get jealous that a famous movie star might do an hour-and-a-half podcast with another comedian and go really deep into their childhood and all this stuff? Yeah. Then they come on with you. Maybe you have 12 minutes and you show a clip, you're joking around, it's very lighthearted. And Seth said, it's not what I do. I do this. I think we do it well. Sometimes I wish Mick Jagger would open up to me for an hour, but that's not the show.
Yeah.
So with CNBC, there's an urgency. There's an immediacy to it. It's the best that there is at capturing what's happening now and bringing in the most important voices on that topic. But the nature of it, they don't have an hour. Yeah. They can't do a deep dive into somebody's book. It's not what they're there for. So that's why I think the ecosystem has room for both.
Yeah.
You can't do what CNBC and Bloomberg TV do, but they can't do what we do. Yeah. And both have a place in people's lives. So
I don't think Bloomberg TV does anything. But one thing I'll say is that I mean that seriously. And MAGA business. I mean Fox Business.
MAGA business.
What I mean? So. And we'll just end it with this. I've been doing CNBC for 15 years. It's one of the longest commitments that I've ever had to anything other than my wife. Shout out, 24 years. We're working on 25. It's pretty phenomenal. I mean, you've done that too. You also wrote, obviously, for many years. Now you're 10 years into Ritholtz at 10 or no?
11.
Or something.
Just turned 11.
It is pretty fascinating. We wouldn't continue to do. No one's getting rich at CNBC. You know what I mean? Unless you're this, that, or whatever. You enjoy it, and it's been something that you've been able to kind of build other I guess, personas, other brands in and around it, and it's been fun.
Same persona, but CNBC has been the most incredible experience for me. Not only because of the exposure that I've gotten to a bigger audience that I never would have been able to, but the people that I've been able to meet, yourself included. Like, there are a lot of people that I consider to be not just professional contacts, but actual friends. And these are people that I got to meet by virtue of really great producers bringing us together and facilitating conversations on the air that then extend off the air. And so it's irreplaceable. And I still think when something's happening in the markets, I understand there are like Twitter people, and I understand there's Reddit, and there's all these other forums, and there's Discords. But in the end, if you really want to know what's happening, nobody on earth does it better than the hard news people at CNBC. When a big story happens, they get the absolute best people to speak on it, and they do it in real time. And podcasts can't do that. Twitter can't do that. Nobody can do that. They do it better than anyone. And for that reason, I think it's maintained its status. And you see all these cable networks disappearing, fading away, MTV, Comedy Central. None of them have been able to preserve that essential quality that CNBC still has.
Yeah, I'm glad you mentioned the producers. You and I think they're kind of the unsung heroes. If you think about some of the people we've worked with, Max Myers, Sandy Cannell, Lisa Villalobos, Kevin Flynn, Jason Gorge. I mean, like, these guys are all they've also been there for a long time too. You know what I mean?
Well, there's an institutional knowledge within that building that nobody in social media has. Nobody in tech world, world trying to do finance. There's an institutional knowledge, and there's a web of connections and network that the longtime producers and news directors at CNBC have that just doesn't exist elsewhere. They know who to bring in for what. It's almost like instinct. They know how to do it.
Yeah, the last point I'll just make about CNBC is, like, if you talk to like senior people at NBC Universal, they'll say we got 99 problems and CNBC's not one of them. Which is definitely kind of interesting. Really quickly, going back to late night, it's pretty fascinating that what do the MAGA people watch at 11:30 p.m.? Because I'm being serious, because these guys every night, and they're all guys, by the way, they just savage, you know what I mean? Like certain folks out there, and Saturday Night Live, that sort of thing. So what is your favorite late night program? And again, you probably see it. No, but you're watching the clips, like going back to it. So who's your favorite personality?
Well, I'm a Saturday Night Live guy.
Yeah.
And I always will be. And
do you see that Nate Bargatze's coming back for the second time in a year? Can you remember the last time that's happened?
Well, what they figured out was that what's currently happening in comedy should be reflected on Saturday Night Live.
Well, they had Shane Gillis back.
On. They cannot pretend. They cannot pretend any longer that this incredible groundswell for these independent comedians that have built their own platforms, that are selling out arenas all over the world. They can't pretend these people don't exist. I want to run a one-man campaign to get Tim Dillon to host Saturday Night Live.
I don't know Tim Dillon.
It'll never happen because he's trashed Saturday Night Live so much, but like, he is the best of that crop of comics. He's the most fearless.
I got to check him out.
You would die. I don't know if you'd make it one episode, but I still love Saturday Night Live, and I love that they're bringing Shane and these people.
One of the best skits I can remember easily in the last 10 years was that Nate Bargatze when he was George Washington. Did you see that? We'll put that in the show notes. That was like genius. Okay, well,
is he the season opener?
October 5th, I guess.
I think that's the first.
Coldplay is the
so that in and of itself is that's a statement.
Yeah. I love that Jon Stewart's back just Monday nights. It's kind of like Rachel Maddow just doing Monday nights. Yeah. It's like to see him again 8 years later. It's great. And what they've done with all their correspondence, that Desi Lydic, she's awesome. That Klepper guy, Costa, Ronnie Chang. It's kind of cool how they're rotating them as hosts. I think The Daily Show is as good as it's ever been, by the way.
It's just if that were on Netflix, it would be like wildfire.
Yeah.
The fact of where it lives makes it really hard for it to get discovered.
Yeah.
And that's an interesting thing because I think we always thought like do great content, it'll get found, and to some extent that's still true, but distribution is way more important. Netflix could at any moment decide we want to make this the number one show in the world, and they put it on the homepage, and it just they can will a hit into existence by virtue of the power of that much distribution.
Couple things on Netflix. Okay, so they were never going to do ads. They're doing ads, and it's one of the fastest growing businesses. It's pure
live sports.
Yeah, so, and then live, I was going to say. So I was actually in LA. A good friend of mine, Chris Chen, works with David Chang, does all his media stuff, and I went to one of their live shows. Okay, so think about this. So David Chang, he's got Seth Rogen across the table. He's cooking for them. It's a bunch of, it's 1 hour, and it's live. And, supposedly, and this is not coming from Chris, I've seen some of the data, it's like, fine, they have the velvet rope, the live thing, but it goes up exponentially, the views afterwards. So it's kind of interesting. They're experimenting with some of this stuff, and then they're able to raise prices, which is pure margin. Like, think about that. So I think live is going to be really huge for Netflix. I think that's one of these stocks that on any pullback, you just buy.
So, what's interesting? So we do one show a week that's live on our YouTube channel.
Yeah.
We do What Are Your Thoughts at 5 p.m. every Tuesday. Mm-hmm. And Michael and I rarely miss, unless we're like traveling for business. Yeah. So, and if one of us is traveling, they'll be in a hotel room. We really try to make sure that we're building.
You need the consistency.
We want to build an audience that comes, and you know what? No matter how big the network gets, or no matter how many views the show eventually gets, the live audience really doesn't change much. It's between 1,200 and 2,000 people.
Yeah.
It's 5 p.m. Eastern, and I understand people are still at work. We love that audience so much because it's the same people, and they're in the chat live, and they know each other now. We can't get that audience to 5,000 unless the stock market is crashing. Right, but here's my point. Let's say it averages 1,500 people are there for the live. The eventual video on YouTube over the course of the week, because it lives,
builds.
It might do 50,000 views. It might do 20,000. The live number is so constant. And it's a really interesting way to think about what we do. There's an audience that is ready live and they want it immediately. And that's a core audience, but it's not the whole audience, and it's not even representative of the overall size of the audience. Mm-hmm. If you play to that audience, the rest of the audience will love it either way. And I think that that's like a really great guiding point, not only for Netflix, but for every media company to understand. Play to the core fans. Even if that core fan group doesn't grow, you could build something really special around it.
So we have a very similar situation, and I do think it's fascinating. One mistake that we might make is that we do 3 live things a week. So like we don't let it breathe.
There might not be as much of an appetite
but in
for that.
We have that similar live base. And those are our true fans. Those are our 1,000 true fans. You've read that, right? Yeah. So now that was written 15 years ago or whatever, and we'll put that in the show notes. And maybe it's 10,000 true fans. You know what I mean? Whatever. But it's really an interesting exploration of that whole experience. All right, I want to go back to some stuff from the book. So this was 5 hard truths investors must hear. Yeah. Okay. And I think this is pretty fascinating. So I'm going to rip through them, and maybe you can kind of comment on a few of them. Okay. So there are a few excuses for being an uneducated investor. No one knows what's going to happen, especially the experts. And you're very consistent on that for years and years and years. Investors have more to fear from other investors than from the market. No risk, no reward. Time goes faster than you think. So maybe there's a through line, or maybe speak to just why those 5 hard truths are so important to the kind of the way that you speak to investors and viewers and listeners.
Well, all right. So the expert thing, this is a true story. My son came to me last spring. He said, "Dad, I'm in the stock market game in my school, and there's 100 kids doing it, and I really want to win." I said, "Okay, how does it work?" He says, "Well, simple. We could buy, or we could do something called selling short, which I don't really know what it means, or we could hold or whatever, and we have unlimited amounts of transactions, and we have 90 days. And whoever grows their portfolio from a fictional, it's a fictional $10,000, whoever grows it the most wins the contest." So he's like, "You're like, famous like stock market guy, so we're going to win, right?" I'm like, so I had to explain to him.
I love that.
All right. So I'm supposed to be the expert.
Yeah.
So I explained to him, an idiot, can wake up, throw a dart, and win this contest by accident. And just because I know more than all your friends' dads and all your friends combined, it doesn't mean that in a 90-day period, Like, I can do the right transactions that will lead to us. And I go through this whole explanation with him, and he goes, what the fuck do you even do? Like, it's mystifying to him that the biggest stock market expert in the town isn't completely confident that we could destroy everyone. And why is it so mystifying? If he were in a automobile building contest and his friend was Henry Ford's son, it would be obvious Henry Ford's son is going to win the car building contest. Like, there's no ifs, ands, or buts about it. So why doesn't it work this way in the stock market? It's a really fascinating thing to consider. And just explaining that to him, it's like confirmation of what I'm saying in the book and what I say elsewhere. Just because somebody knows more about investing than you, that doesn't mean they'll be able to produce superior results. And in fact, very often, it works in the opposite direction. You could know too much. You could draw too heavily on previous experiences that are no longer applicable to the current market environment. So that's a big one with me, and I try to remind people of that. Every time something happens in the markets, I try to point out, not, hey, look at that guy, he's such an idiot. It's like, this is one of the best traders of all time. He went on CNBC and said he's risk off, and then the stock market ran up 40%. Does that make him an idiot? Or does that reinforce to you how hard it is to predict what 100 million investors are going to do with their money over the next 12 months?
Yeah.
The takeaway should be the latter thing.
All right, talk to me about no risk, no reward. You had a great piece on David Tepper, Appaloosa, and you talk about how he started out is pretty, not fancy in any way, shape, or form, and he kind of built an amazing track record. He dropped the mic, and by the way, he's not particularly popular in Charlotte right now by any means. He bought the Charlotte Panthers once he obviously made his billions. But there was a risk-taking, there was an appetite there that made him very unique. Is that fair to say? And he wasn't afraid to kind of be vocal about it. You make the point. He used to come on Scott's show a few times a year. He'd make a really big call. Most of them were pretty right? It was like a timing thing. And when I think about the no risk, no reward, to your point you just made, I know tons of brilliant market minds, but they're risk adverse. They might be an analyst. They might be, this sort of thing. And so if you're not willing to take risk, you can have a nice career in this business, just advising the folks that want to take the risk. And I know that's a more actively managed sort of thing. So talk to me a little bit about that and maybe how it's changed over your career.
So Tepper is my favorite of the name brand hedge fund managers. I know he's not running a hedge fund in the traditional sense anymore, but he is a risk seeker. He's one of the great risk takers of all time. And, he uses terms like balls to the wall. Yeah. Like most people running $10 billion
balls
hedge funds.
long. You've heard that, right?
They don't say balls long.
Yeah.
He's very authentic. He is exactly who he sounds like and who you think he is. I identify with him because he had a massive chip on his shoulder when he started his fund. The way he left Goldman, the way he thought he was treated by Goldman or disregarded. I love stories like that because I see myself in those types of people. Mm-hmm. But yes, one of the things that I try to explain, there's this type of person. It's a social media person. Usually it's somebody who manages no money in real life. They can't because they would be out of the business. They talk about being fully hedged. What the fuck does that mean? You're fully hedged. Where's your upside? It's impossible. It's impossible to fully protect your potential downside and make any money. You could turn a stock portfolio into a checking account and make sure that it never falls. It'll also never go up. I think one of the things that we've done effectively with our media and our content is we make it clear to people, no. This is not about fully protecting against risk. This is about forcing yourself to take risk, especially at moments where it feels particularly uncomfortable. That's what investing is. Investing is not, how can I make sure I never lose money? If that's your mentality, you're not going to last long as an investor, or you're never going to go anywhere. So I think we do a good job at twisting that conversation. It's not that we don't care about risk. It's like there are certain risks that don't pay off, and then certain types of risks that do. But part of taking risk is being disappointed at times.
Yeah, you're never putting your customers in sort of outsized risk. You know what I mean?
Well, they don't. So what we do doesn't require that. Yeah. We're not competing with a field of hedge fund managers that are trying to produce outsized returns. We have people that want to make it from point A to point Z and not get knocked out of the box along the way. So we don't need to take like wild risks.
Yeah, it might feel risky when you're buying on March 7th, 2020, but at the end of the day, it fits into a lot of the kind of, the infrastructure, the themes that you've kind of laid out in the book.
Do you know that the S&P 500 closed positive 20% in 2020?
Yeah.
So if you're the world's worst market timer,
and
you put a lump sum, you put $3 million of cash into the S&P 500 on March 7th, you feel like an asshole on April 1st. But by the end of the year, you actually are higher, which is an extraordinary thing. Most people don't know that 1987 the S&P closed up.
I know.
So okay,
and 2020 it closed up,
so,
which is fascinating.
So even if you suck and you have the world's worst timing, the nature of this thing is such that it historically doesn't take a long time for you to be bailed out.
Yeah. Well, you had a bit here. I don't like talking shit about too many people in the business, but I'm just going to say it. I mean, Bill Ackman might be one of the biggest dicks in the business. And, the day that he came on and
I'm not offended by him the way that a lot of people are.
So, and you were very clear about that, okay, in the book. And so I just want to say this, that like the day that he came on halftime with you and Scott. It was like the last day before everything really shut down, in my opinion, because, I remember, and I'll tell you why. So he was literally just crying from the rooftops about what needed to happen, the lockdown, and you go through all that sort of stuff. Well, little we know that he put together, a $27 million hedge that turned into be this amazing trade. But he was shouting at the White House. He was shouting at institutions, lock it down, close it up, all that sort of stuff. And, I came on Fast Money that night, and it was actually only Brian Sullivan who was hosting that night, and we just weren't having full panels of guests. You and I actually did a early, you remember that? It was like
they took our temperature.
No, it was but it was like they had just a few people in. It was actually in February. Do you remember this? It was one of those markets in turmoil sort of thing.
Yeah, probably.
And it was about COVID and all that sort of stuff. And so, but on the day, I think it was March 8th or whatever it was, I was in there. I was standing at the board, and Brian's asking me all these questions. And if you want to think of me as a permabull, I was like, that's the craziest thing I've ever heard anybody go live with. You know what I mean? Screaming about the markets, the fear that he put into, millions of investors. So to me, there's certain things. And then a month later or 2 months later, we hear the best trade that ever existed, 27 million into 2 billion. I don't know.
Can I say one thing though? Yeah. Bill Ackman at that time was not tweeting a lot.
Yeah. He's the worst.
He is
Twitter
now
person
he is
next
now
to maybe one
tweeting.
other.
He is now tweeting on an hourly basis.
Oh, yeah.
And I don't, I'm not on Twitter. I don't really pay attention to it. But one of the things about him is that we've learned is he's a mood ring.
Yeah.
He's very impulsive. He's got strong opinions, but they come about really quickly, and then they can change. And he'll read a New York Post article, and there's a tweet thread coming immediately. So one of the things that's interesting now, we have like high frequency tweeting by some of the most well-known hedge fund managers. Like Dan Loeb is very active. Yeah. Steve Cohen lasted like 2 days.
Oh, he got savage. He got savage.
And
it wasn't about the Mets either.
But my point is, the more that you in real time share your opinions, maybe you get value out of that personally, but your true nature starts to emerge more for everyone else that's paying attention. And in hindsight, like Ackman pulled off an incredible trade, and he was not necessarily trying to produce more fear to make his short bets work because he had already been closing those out. I think he genuinely cared. My opinion.
I think he only gives a shit about himself.
Maybe, but I think he cared about the health emergency because it would affect him and his other investments. It's not like he went short the whole market. He had long positions too. So I think I think it never looks good when you are so vociferously bullish or bearish to the point where it appears like you're trying to influence prices. We know the SEC doesn't like that, and we know most investors don't like that. So maybe it's like a bad idea in general to come on in a heightened moment of panic and scream anything.
Yeah.
Like it's a sensitive moment.
Hey, by the way, he's screaming now, and again, I'm not on Twitter either, but I see it talked about a whole heck of a lot. People kind of share the tweets with me, that sort of thing. The stuff that he's screaming right now about is not market related; it's MAGA related. And I actually think a guy like him is going to be on the wrong side of history in the not so distant future. And I think people are not going to think that well of some of these folks who are.
He'll be fine.
Well, okay. Well, I mean, his billions will be fine, but I think his reputation might not be going forward. And so whatever, people can rehabilitate that stuff. All right, we have two more things to do before we get out of here. I really want to talk about how you're thinking about Gen AI as a secular computing or tech shift. Okay,
in how many minutes?
No. I just want but I want to get a sense for how you're maybe using some of these tools within your own business and that sort of thing. And so, like, we've created a podcast. We started 3 months ago where we curate the top 10 stories that we think that have gone on in the day, markets, business, that sort of thing. We put it in Perplexity, which is obviously you could use whatever, ChatGPT, you could use Llama, you could use Claude from Anthropic. We give it a prompt, summarize it, 30, 45 seconds. Then we put it into a voice bot. Okay, it reads it. We call the voice bot Brunson, pretty cool. And we have a under 10-minute podcast that goes out right after the close, and it's called Market Matrix. And we think it's really cool. Now, is that using generative AI? No, it's using AI tools, right, to create a piece of content that we think is really cool. But in your business, there are going to be lots of processes that are going to be using generative AI to really help. So just give me a 2 cents of, like, how you're thinking about it as a technology you guys are evaluating. And I'm sure there's certain things that you're willing to test, whether it's a Copilot
So
or
the first wave of AI tools are all built. They're all like note takers. This is the most obvious application for a financial advisory firm.
Yeah.
And there are 18,000 RIAs, plus there's Goldman, Morgan Stanley. Everyone right now is piloting some version of this. Basically, the way wealth management works is you have certified financial planners who are talking to clients. The more time they can spend talking to clients, the better, because that's what clients really value. Okay. The problem is, for one of my advisors to get on the phone with a $15 million household, it's about an hour of prep work before that conversation, because they have to go back through all the notes of prior conversations, make sure everything that was discussed then has been followed up on, and be ready to talk about that kind of like the meeting minutes before whatever is the proactive conversation. Then you have the call. Let's say it's 30 minutes. Let's say it's 45 minutes. Let's say it's an hour. You get off the call, it's another hour of what did the client just say? What are the follow-up items? What is the paperwork we need to send out because they just decided they want to fund this charity, or they're about to buy this piece of real estate, or they're going to inbound wire this money? That's another hour. So a 30-minute meeting could become 2 to 3 hours on the front end and the back end. What AI note-taking is doing in my space now, it's getting my planner up to speed with what's already happened in 10 minutes, and then the follow-up meeting is 10 minutes because the AI is writing alongside in the meeting. It might be Zoom's generic tool, or it might be, there's a company called Jump that's signing up advisors, like I heard like 5 a week. There are a bunch of these. Salesforce will build a version. It'll be more generic. What happens after the meeting, the AI, which has listened to the conversation, is sending an email to the client. The advisor is not doing it. The AI is saying,
but you're reviewing it, correct?
Of course.
Okay, yeah.
Here are the things discussed in the meeting just now as a courtesy for you, so you have a record of it. Here are the 5 action items that are supposed to happen. That same email is going to the advisor, and then instructions are going directly to Salesforce for the advisor's staff. Mm-hmm. Please prepare Form 1225B. Please send this email to the bank about that. So the AI is capturing everything that happened during the conversation, curating it into just the highlights, and then sending instructions to the advisor's staff. These are all the follow-up items that need to happen. As that becomes more prevalent in wealth management, every great financial planner will be able to scale up how many clients they're dealing with and maximize the amount of face time they're giving clients and minimize the amount of administrative and paperwork stuff that clients don't care about at all. This is huge.
Yeah.
And I have to tell you, I don't know who's going to win. Which is it going to be a startup? Is it going to be Salesforce? Will it be Zoom? Will it be Microsoft? probably room for lots of winners. Within 2 years, this will be industry standard. We sit in a really interesting place. We hear from all the startups that they all want to be, involved with us.
Right.
So we're seeing things like an AI that gives the advisor after the call a sentiment check. This is when the tone of the conversation went from hopeful to nervous. And that tells the advisor how to be a better advisor. Mm-hmm. This is the thing I need to address the next time I speak with this family.
So interestingly enough, and remember, you don't remember, I don't remember, but our parents probably remember when ATMs came out, right? Everyone's like, it's going to put the bank tellers out of business. And really what it did was it gave the bank tellers more opportunities to cross-sell other products and focus on some things to grow the businesses. And I'm assuming that if this goes really well for you, and there's, let's say, another kind of tool that helps the processes, again, you're not going to be firing anybody. It actually is going to give you guys more capacity and stuff like that. Let's go now quickly, and that's a great example of how a very small part of our economy is going to use something to gain productivity. Let's go quickly to the stock market. We talked about this for the beginning. It's a very narrow group of stocks, companies that are benefiting, at least from a market cap perception right now. You just mentioned Salesforce. Salesforce is unchanged on the year. Think about that.
Yeah.
In July of 2023, they were telling a great story. Adobe was telling a great story. Zoom was telling a great story. The market has disregarded what they might be able to create in the future right now, at least in the stock market as we're September 25th, 2024. Yeah. And all of the value creation is accrued to the hyperscalers. So it's Amazon, it's Google, and it's Microsoft. And then obviously Apple just joined the party a little bit. NVIDIA has been, gained $2.5 trillion in market cap since ChatGPT was released in late 2022. My personal belief is that the next phase of this, I think they're going to overbuild capacity, and there's going to be a period where, these stocks kind of, the valuations contract, but then they're going to start, this is investors, thinking about how it's going to change the oil and gas business, how is it going to change the pharma business, how is it going to change financial, that sort of thing, and that's going to be the next wave of it, whether it happens right after
this. What if the stock market is right in assigning a 20 multiple to the S&P?
Yeah.
Because every company in the S&P 500 is about to get this dividend from the use of AI tools. Now, it might take 3 years to materialize. You hear a company like Domino's Pizza say on their conference call, they just spent $45 million on generative AI.
Right.
And you're like,
yes,
fucking pizza?
Yeah.
What are we doing here? The answer is making their delivery people more efficient so they can do more deliveries.
Logistics.
Making
Walmart
it so they need
making
it so they need less software engineers because the software is going to start writing itself to improve the app. So we don't know for sure that will happen, but it's quite possible that the true promise of AI accrues to the bottom line of the S&P 495 in 2025 more so than it does the revenue line of the S&P 5. So that would be a really interesting turn of events.
That is 100% my view, and why I think, NVIDIA or Apple or Microsoft or Google, they're bound to have $3, $4, $5 trillion market caps at some point in the next 10, 15 years. One of them or two of them may go by the wayside, and one of the reasons why like a Google might have massive headwinds is that they dominate, like search and digital advertising.
Think bigger though. What if drug discovery becomes 50% cheaper than it is today? What does that mean for the rate at which we bring new drugs to market, and what does that mean for margin on the selling of drugs that cost half the price to develop? Right now in drug, we only know it's like health insurance. The cost to develop a drug only goes in one direction.
Right.
What if that's not the case? Because we get better at the discovery process.
Here's another example, media. Think about this. So, Disney bought Pixar, for $8 billion. This is like 20 years, 15 years ago, whatever the hell it was, right? And they spend hundreds of millions of dollars to create whatever, the latest kind of thing is, the princess movie or whatever the hell it is, right? And then hopefully it makes $1 billion globally.
Right.
Think about what that's going to do. I mean, like a Disney could get re-rated on a massive scale, and no one's kind of viewing this right now. You and I could talk about this for an hour. All right, last thing I want to do here. This is going to be fun. This is going to be like a speed round a little bit.
I'm ready.
So before you got here, I went to Perplexity, and I gave it this prompt. You ready? What are the dumbest questions I can ask Josh Brown, CEO of Ritholtz Wealth Management, on a podcast? This is going to be fun, and I want you to
look at the productivity.
I want you to rip through some of these.
All right,
Here are some of the. This is the answer. Here are some of the intentionally silly or outlandish questions you could ask Josh Brown on a podcast while still keeping things lighthearted and professional. Dude, that's genius.
Let's go.
Okay. I did this actually to the CEO of Perplexity when he was on our podcast. I didn't say intentionally silly. I asked, what are the best questions? All right, you ready? If you can invest in any financial company from movies or TV, which one would you choose and why? So fictional company from movies or TV. Fictional companies of movies and TV. Yeah.
Shit. Like that's such a great question.
Is that a smart question?
Yeah.
And it's not sillier.
No, it's not silly
like
at all.
Spacely Sprockets, maybe? Like, is that one? Like, if you look at SpaceX and Starlink and the valuation you're going to have there, would you invest in Spacely Sprockets?
I feel like it's easier to answer this in the opposite direction. Like, what would you not invest in? And you would be like Dunder Mifflin.
All right. Great. All right, we got a bunch here. Let's get through them, all right? What's the most ridiculous stock ticker symbol you've ever seen?
Oh, wow. I need a second. I want to say Moo.
Okay, I'm going to say...
We had the agricultural ETF, and the ticker was Moo.
I'm just going to say... I'm not going to say it. I'm going to say General Mills. It's GIS.
Yeah, why is it that? That's wild.
That's bad. All right, so if you had to explain the stock market using only emojis, how would you do it?
Eggplant, water splash right now. I'm being honest with you.
I love that, eggplant. If Wall Street was a high school, which financial institution would be the popular kid and which would be the class clown?
Oh, that's a great question. I don't know, Class Clown City? Is that fair?
Sure. All right, Amanda Diaz, who's our fine producer, just texted me because she didn't know I was going to do this. She goes, this is funny. Okay. So we're on to something here. What's the weirdest thing you've ever seen on a company's balance sheet?
The weirdest thing I've ever seen on a company's balance sheet? Well, probably like the private jets is the thing that jumps out. It never works out well for the companies with the highest usage of private jets.
Yeah.
It's always a sign that this is like an unserious situation. And GE he had two jets, one that took him where he needed to be, and one that followed him just in case he needed a backup jet.
Nice. I remember that.
And
it's weird that GE,
almost
fell
went under
75%. Yeah. All right. I think for me, and again, I didn't read these questions myself, but I'm going to come up really quickly. WeWork had community adjusted EBITDA. Do you remember that or something like that?
Hysterical.
Okay. All right. If you could create your own cryptocurrency, this can be in your wheelhouse. What would you name it, and what would its gimmick be?
Oh, I would do blank coin, and it does nothing. There's no purpose to it, and I just say it.
Well,
straight
there's
out.
plenty of those.
No, but they pretend. I would just say there's no reason for this to exist other than it exists, and it would probably become one of the top 10 most valuable coins.
Yeah, you know who created that? Donald Trump. Okay, so I mean,
that exists to pay his lawyers.
Okay, fair enough. If you had a tattoo,
that's one last score.
This is really
the Trump coin is like, dude, one like
enough of the Bible,
enough
heist. Of the stakes, enough of the bullshit schools. Let's go into crypto.
Just literally imaginary currency.
Yeah. Right. All right. So here's one. If you had a tattoo, one financial chart on your body, which one would it be?
Oh man, I think probably just S&P 500, 100-year chart.
Yeah.
So the inception is 1957. So 50-year chart of the S&P 500, I think, is the best chart you could tattoo.
What do you
yourself.
think Batnick would put on himself?
Oh, probably like FAS or something, like a triple level. Yeah,
triple level financial ETF.
Batnick loves the action.
And you know what he would have said? He would have said, and I put it on March 10th, 2009. Okay, we got time for a couple more here?
Yeah, man.
This is fun. What's the most absurd financial advice you've ever heard someone give with a straight face?
Anyone pitching variable annuities to people under the age of 40.
Yeah.
It's like on its face, it's the most psychotic thing, because basically you're capping someone's upside while telling them they're getting stock market exposure. You're locking someone in that will probably have a better use for the money when they want to buy a house. It's just like everything about that, or whole life insurance.
Yeah.
Like just selling something to someone you know they don't need because the commission is higher, and using fear to convince them why it's a smart decision. That's the thing that turns me off more than anything
You know
else.
who agrees with you? That guy.
Gold IRA is just bullshit on stilts.
Yeah.
That bothers me a lot.
Probably a lot of DeFi stuff. You know who agrees with you is that guy who's always on TV who got canceled. He's like, I don't.
Fisher.
Yeah, that guy.
Well, he's right about that.
Yeah,
So.
well, he's right about that.
By the way, he had the last laugh. You know what his AUM did after he got canceled?
No.
It doubled.
Wow.
He's like a $200 billion firm. So
good for him.
You know.
All right, we got two more. If you could trade places with any historical figure for a day to manage their finances, who would it be, and what? What would you do? If you could trade places
with them just to manage their money.
So this is hallucinating a little bit. Okay,
What is
so
that even
let's
about?
move on. Let's get to the last one. This is really good. If aliens landed on Earth and asked you to explain the concept of money in 30 seconds or less, what would you say?
Money represents freedom. Having money gives you the ability to decide how you're going to spend the rest of your life.
It's optionality, basically.
So I'm glad we brought this full circle. This is what we try to explain to clients: is there's a purpose for this money. It's not about the holdings and what stocks you're in. You're going to spend it. You're going to sell these stocks one day. So what we're really doing here is giving you as much optionality as possible. That's the point of taking the risk. The point is that you know for a fact 20 years from now, whatever you're spending money on now, it's going to cost more then. We want you to have the ability to spend it how you want to spend it. And that's the premise of why financial planning is more important than portfolio management.
All right, that's pretty good. Just to be clear, Perplexity gave us a little disclaimer. Remember, while these questions are meant to be humorous, it's important to maintain a respectful tone and not ask anything truly offensive or inappropriate. So hopefully I was not inappropriate.
You nailed it.
All right, really quickly, this is it. Before we get out of here, this is the book. You Weren't Supposed to See That by Joshua Morgan Brown. I remembered that. We're going to give away 100 of these books to the first 100 people that leave a review for the On the Tape podcast. Screenshot it, send to Amanda, contact at riskreversal.com. Josh, this was one of the best hour and 20 minutes I spent all week. I hope the people enjoy this thing.
I was going to say all year, but you limited it to all week.
We could have done like a Lex Friedman or a Tim Ferriss podcast, the ones that never end for like 3.5 hours, but we're not going to do that.
Nope.
All right, you and I are going to do this again over maybe some steak and some cocktails and this and that.
100%. And let me just say thank you so much for all that you guys do. And I've been a fan since day one. Yeah. Shout to Guy, shout to Danny, and I think you do a great job. So thank you for that.
We feel exactly the same way. All right, I hope you'll come back really soon.
What are you doing tomorrow?
All right, let's do it. All right, thanks, guys. We appreciate you being here.